The price is lying right now, and the spread is the part that can't keep the secret. Because while everyone's hypnotized by the big clean number on the screen, the market's internal wiring is throwing sparks, and you can hear it if you know where to listen. This isn't one of those slow-motion, silver is undervalued speeches. This is a stress story, a calendar story, a positioning story. And if you understand the hidden detail, why the front end of the curve is behaving like it S under siege, you can stop watching silver like a chart and start watching it like a system. Silver has been acting like it's trying to rip the steering wheel out of the driver, hands, not drifting, not politely trending, snapping. And markets only snap like that when something breaks in the plumbing or when the crowd on one side of the boat realizes the other side is empty. That's where the real pressure starts. You've seen the headlines, big targets, $100 near term, and the kind of long-term number that sounds insane until you remember, silver is a small market with a giant personality. But the real question isn't, can it hit a number? The real question is, what forces people to pay up right now, regardless of what they believe? Because belief doesn't move a market. Forced behavior does, and that's not the part most people are tracking. Here's the first tell, and it's not the spot price. It's the feel of the physical market. Before the chart looks obvious, you feel it in the real world. Premiums, availability, delivery timelines, and the way dealers suddenly stop negotiating. When silver is calm, the physical side is boring. The spread between what you see on the screen and what you can actually source stays reasonable. Delivery feels routine. The whole thing feels like a commodity. But when silver is under stress, the physical market starts behaving like it's rationing, and the language changes. In stock turns into limited. Ships tomorrow turns into 2 weeks maybe. And the real giveaway is the tone. Not panic, not excitement, tightness. And tightness doesn't come from YouTube predictions. It comes from constraints colliding with time. Now let's pull the curtain back on the hidden detail, because this is the piece that reframes everything. The price can lie, but the curve can't. The futures curve is where urgency shows up. The curve is where the market tells you whether it wants metal later, or whether it's paying a premium to get metal now. And when the front end starts acting like it's more valuable than the back end, that's not sentiment. That's a message about scarcity, financing, and delivery preference. That's the market saying, I don't want a promise, I want the thing. But that's not even the most dangerous part. The most dangerous part is what that curve forces participants to do. Let's make it simple. In a normal commodity market, future months are often priced higher than the front month. And that's not bullish or bearish by itself. It's just carrying cost. Storage, insurance, financing, time costs money. That's called contango. It's the market saying, if you want it later, you pay a little more because someone has to hold it. Backwardation is the opposite. It's when the front month is priced higher than later months. And that inversion is the market paying you implicitly to give up immediate supply. It's saying right now is precious. Not in a poetic way, in a mechanical way. And when silver's front end tightens, even briefly, it flips behavior across the ecosystem. Because if immediate metal is scarce, the people who are short don't just lose money, they lose options, they lose time. And that's when price goes from rally to event. And that's where the real pressure starts. Now, if you're hearing backwardation and your eyes glaze over, don't let it. Because this is one of those concepts that sounds academic until you translate it into what it forces people to do this week. When the front month is expensive relative to later months, anyone who needs to roll a position forward pays a penalty. Anyone who is short near term and planning to roll has to deal with a curve that S screaming at them. Anyone who is trying to source metal for delivery has to decide whether to pay up now or gamble that the pressure eases. And that means decisions get pulled forward in time. It accelerates the market. It makes the next few sessions matter more than the next few months. Well, that's why silver can cover $10 in a week and then whip $10 the other way without new information. The information is the constraint itself. Now let's go one step deeper, because this is where most retail investors get emotionally ambushed. Everyone sees inventory numbers and thinks they're looking at a warehouse full of guaranteed supply. They're not. Not all inventory is equal. This is where the paper versus physical debate stops being a vibe and becomes a structure. In the exchange world, you have categories. Metal that is eligible to be delivered, and metal that is registered as deliverable. Those two words sound similar. They're not similar. Eligible can mean it meets the specs and it's sitting in a vault. That does not mean it is committed to be delivered. It means it could be delivered if the owner wants to. Registered is closer to ready for delivery against a contract. So when people say there's plenty of silver in warehouses, you always have to ask the next question. How much of that is actually available at the margin under stress when the incentives change? Because in a squeeze-like environment, the difference between could and will becomes the entire story. And that's not a conspiracy. That's basic incentives. If you own metal and the market is paying you more for immediate supply, do you volunteer it cheaply? Or do you wait until the market begs? That's the hidden detail turning into a lever. And now we hit the calendar, because this isn't just a supply is tight narrative floating in space. Timing matters. The calendar is the catalyst. Late January into month end is one of those periods where liquidity can thin, books get squared, and institutions start caring less about being right and more about being flat. If you've traded long enough, you know this rhythm. Month-end rebalancing, risk limits, performance optics, and the simple reality that when big money changes exposure, it does it when the calendar gives cover. And sitting right in that window is a policy catalyst that can amplify volatility. Markets don't need a rate cut or a hike to move violently. They need uncertainty about the path. They need to reprice the distribution of outcomes. And when you're holding a metal that reacts to real rates, currency stress, and risk appetite, that calendar event becomes a pressure plate. But here is the trick. The headlines will make it feel like the policy meeting caused the move. That's the cover story. The mechanism is positioning and liquidity meeting a curve that's already strained. Because if the market is already paying up for immediacy, it doesn't take much to tip it into forced behavior. That's the next detail that flips the whole setup. Let's talk about the playbook that shows up when markets move too fast. Margin. When a market runs hard, exchanges and clearinghouses don't watch it and shrug. They manage risk. And managing risk often means raising margin requirements, which increases the cost of holding positions, especially leveraged positions. This is not a moral judgment. It's not good or bad. It's a volatility mechanism, but it has a predictable effect. It turns price moves into forced flows. If you're over-leveraged and margin gets raised, you don't get to say, I'll just wait. You either post more capital or you reduce the position. And reducing positions in a fast market is not a gentle process. It's liquidation. It's people selling because they must, not because they change their mind. And that's where the real pressure starts. Here's a quick math check, brutal and honest. Imagine you are positioned in a way where a 10% move against you is uncomfortable but survivable. Now add leverage, add margin changes, add liquidity thinning. Suddenly a move that looks like noise on the chart becomes a forced decision in your account, overnight. That's why silver is so psychologically violent, because it has a habit of giving you the correct long-term direction while punishing the wrong time horizon. It's not enough to be bullish. You have to be structured. You have to understand how the market tries to shake you out even when you're right. And yes, sometimes that shaking is just the natural consequence of a small, volatile market. Sometimes it's bigger players managing their own exposures. Either way, the result is the same. If you let price action dictate your emotions, you become liquidity for someone else. Now, let's stack proof the way a skeptic demands it. Multiple layers, different signals all pointing to the same pressure theme. First layer, term structure behavior. When the curve tightens at the front, it's the market telling you immediacy is scarce. That's not a headline, it's a mechanism. Second layer, inventory quality. Registered versus eligible isn't trivia. It determines how much metal is actually available to meet delivery obligations when stress spikes. Third layer, physical premiums and delivery friction. When physical availability tightens, it tends to show up first in retail and small wholesale channels. Delays, higher premiums, rationing behavior. That's not the whole market, but it's a symptom. Fourth layer, institutional flow behavior. Not what they say, what they do. Big vehicles that hold silver and the way money moves in and out can add or remove a steady bid. Even when flows are flat, the structure matters. If demand is sticky and supply is slow, it takes less incremental buying to move price. Fifth layer, cross-market context. Silver doesn't live alone. Real rates, the dollar, inflation expectations, and risk appetite all push and pull on it. When those macro variables are unstable, silver's volatility expands. Sixth layer, chart structure. Not lines on a screen, but the behavior around levels, breakouts, retests, failures, and the way price responds when it hits a psychological threshold like 100. Because if this one level breaks, the math changes. Not in some mystical way, in a flow way. Now let's talk about that 100 level, because it's doing something to people's brains. Round numbers are magnets. They're also battlefields. Above a level like 100, you get a new kind of attention. Momentum funds notice, media notices, skeptics start talking, and shorts, especially tactical shorts, have to decide whether they're fading a move or stepping aside. And here's where silver gets reflexive. If price presses into 100 and holds above it, it can trigger a second-order effect. New buyers arrive because it broke out, which forces hedging and de-risking behavior from people who were positioned the other way. That buying then validates the breakout, which attracts more buyers. Reflexivity, not magic. Feedback loops. But the other side matters too. If price tags 100 and rejects hard, especially on thin liquidity days, it can create the illusion that the move is over. That's how traps are built. A sharp rejection can scare late buyers and embolden shorts. Then, if the curve and physical signals remain tight, the market can turn around and run those shorts over later. That's the loop. So don't just watch the level. Watch the reaction. Watch whether pullbacks are controlled or violent. Watch whether dips are bought quickly or whether price bleeds lower with no urgency. Watch how the market behaves on the days when the dollar pops or yields spike. That behavior tells you whether silver is being accumulated or just being chased. Now, let's address the big targets without turning this into a fantasy. A $100 near term is not a guarantee, and anyone selling it like that is either naive or selling you something. But as a structural level, it makes sense as a magnet in a fast move. The more interesting question is what happens if silver accepts above it. Because once a market accepts a new handle, the next zones tend to appear where the next meaningful supply sits. Prior consolidation regions, psychological increments, and the areas where positioning flips. That can be 105, 110, 120. Zones, not promises. And the $220 long-term number, that sounds outrageous until you frame it correctly. Long-term targets in commodities are less about valuation and more about regimes. A regime where real rates are pressured lower, where currency stress is persistent, where industrial demand is structurally rising, where supply is slow, and where the market repeatedly discovers that immediate metal is more valuable than paper promises. Those regimes can produce price levels that sound impossible in the prior regime. That's not a prediction. That's how convexity works in a small market. When the float is tight and incremental demand rises, price has to do the rationing. And rationing in commodities looks like spikes. But here's the counterpoint you have to respect, because skepticism is a feature, not a bug. Silver can be structurally bullish and still dump hard. It can drop violently even if the thesis is correct. Because the market is not a debate stage, it's a margin system. If risk-off hits, the dollar can spike. Yields can jump. Liquidity can vanish. Funds can de-risk across the board, selling what they can, not what they want. Silver is liquid enough to be sold quickly, but small enough to move sharply when it's being sold. That combination is why silver routinely produces the most emotionally expensive chart in the commodity complex. So what would weaken the bull thesis in the near term? Watch for a few things. If the curve relaxes, if that front-end stress eases meaningfully, and it stays eased, that suggests immediate tightness is not escalating. It doesn't kill the long-term story, but it can cool the near-term momentum. If physical premiums compress and availability improves broadly, that's another signal that the physical side is not forcing the paper side yet. If the macro backdrop turns sharply against metals, real rates ripping higher, the dollar surging, risk-off turning into liquidation, that can override everything in the short run. And if price fails to hold key support zones after testing 100, if it breaks down and cannot reclaim levels like the mid-90s, then the market may be telling you the move was a positioning burst, not a sustainable regime shift. That's the discipline. That's how you keep credibility. You don't marry a number, you track conditions. Now let's go back to the supply chain reality, because it's the part that gets oversimplified. People talk about mining more silver like it's flipping a switch. Much of silver production is a byproduct of mining other metals. That means silver supply doesn't respond one for one to silver price. It responds to the economics of the primary metal, the capacity of refining, the regulatory environment, and the time it takes to plan, permit, finance, and operate. Then you have refining and logistics. Even if the raw material exists, turning it into deliverable form and moving it where it needs to be is not instantaneous. Bottlenecks matter. Lead times matter. This is why, in real commodity squeezes, you can have enough in theory and still have not enough at the margin. And that margin is where price is set. Now, let's talk about the institutional behavior that quietly turns loud. Institutions don't need to announce anything for you to observe them. They leave footprints in the way markets trade. In a fast silver move, you'll often see this pattern. Bursts higher, sudden air pockets lower, then sharp recoveries. That's not random. That Wimsey market where liquidity is uneven and where participants are forced to transact at bad prices when they must, the mistake retail makes is assuming volatility means uncertainty about direction. Sometimes volatility is the cost of the direction. Sometimes the market has a direction but needs to clear out weak hands, shake out leverage, and reset positioning before it can continue. And that's where people get emotionally harvested. They sell the dump, then watch price run without them, then they chase the top again. That cycle funds someone else's calm accumulation. A bullish market can pull back. It should. But if pullbacks become cascading and feel like forced liquidation, that suggests leverage got too heavy and needs to be cleared. Third, watch the broader macro tape. If the dollar is surging and yields are jumping, metals can get hit regardless of their own setup. If instead silver holds up while the macro is choppy, that's strength. That's the market saying there's a bid underneath the noise. Fourth, watch the curve and the physical chatter. You don't need perfect data. You're looking for consistency. Tightness that persists matters more than tightness that flashes for a day. Now let's connect this to the long-term target without turning it into a fairy tale. For silver to even flirt with a number like 220 over time, you need a regime where the market repeatedly encounters a constraint and resolves it through price rather than through supply response. That could come from industrial demand rising structurally, from monetary stress driving investor demand, or from a combination, industrial pulling at the base while monetary demand pulls at the top. In that kind of regime, silver's smallness becomes a feature. It doesn't take a massive global reallocation to move it. It takes a marginal shift in how participants value immediacy, security, and optionality. And if the market decides that paper promises are less satisfying than metal in hand, if that preference becomes persistent, then the curve keeps warning you before the spot price looks reasonable. That's the hidden detail again. The curve is the truth serum, but you must hold two truths at the same time. 1, silver can have an explosive upside in a regime shift. 2, silver will try to emotionally destroy you on the way there. It will use volatility against you. It will create fake breakdowns. It will create fake breakouts. It will punish certainty. The way you win is not by being the loudest bull, it's by being the calmest operator, by respecting invalidation, by sizing for volatility, by watching conditions instead of worshiping narratives. So here are the practical guardrails, not as instructions, but as a framework you can use to think clearly. If silver cannot hold above the psychological handle and starts closing back below it repeatedly, especially if it breaks down through the mid-90s and cannot reclaim quickly, that's a sign the market needs more time. That's not the end, but it can be a near-term cooling. If silver holds above 100 into closes and pullbacks stay shallow, that is a sign the market is accepting the new level and the next zones can come faster than people expect. If the curve remains tight and the physical side stays stressed while price consolidates, that's often the setup for another leg because it suggests the market is building a base on top of constraint, not on top of excitement. And if you want one metric to watch that cuts through the noise, it's this. Watch whether immediacy stays valuable, whether the market keeps paying up for now, because if now stays expensive, the pressure doesn't leave, it just migrates. It moves from the screen into risk desks, into hedges, into delivery decisions, into the places where forced behavior is born. Now, a subtle reminder, because this is where trust is earned. None of this is a promise. Price can whip around violently even if the thesis is correct. That's not a caveat. That's the core feature of silver. You're not watching a slow-moving index. You're watching a commodity that lives at the intersection of money, industry, and leverage. So if you're here for certainty, silver will punish you. If you're here for a framework, mechanisms, signals, what to watch next, silver becomes legible. Not easy, legible. And here's the part most people want to say out loud. The institutions don't need to manipulate anything for the outcome to look manipulated. Incentives do it automatically. When volatility rises, risk managers tighten. When risk managers tighten, leverage gets cut. When leverage gets cut, price moves harder. Then narratives get assigned after the fact. Your job is to stop being pulled around by those narratives. Your job is to notice the repeated pattern. Squeeze up, margin pressure, flush down, stabilization, then continuation, if the underlying tightness persists. That's the cycle. And the market will try to make you participate at the worst moment of each phase. So here's what I want you to do with this right now. Don't argue with people about targets. Don't get hypnotized by memes. Watch the levels, watch the behavior, watch the curve, watch the calendar catalysts and how silver responds to them. And keep a two-scenario lens in your head at all times. Controlled retest versus continuation squeeze. If you do that, you'll stop feeling surprised when overwhelmed by volatility and start expecting it as part of the structure. And if you're the kind of investor who demands logic, who wants to understand what forces price discovery instead of repeating slogans, then you're already in the right room. Not because you're bullish or bearish, because you're disciplined, because you want mechanism over mood. Well, that's the identity here. Stay close to people who think like that. Not because you need a crowd, but because the market tries to isolate you emotionally. It tries to make you feel like you are the only one who doesn't get it when volatility hits. You're not. The calm operators are just quieter. Next week, watch the closes around 100. Watch whether dips are bought or punished. Watch whether the market keeps paying for immediacy. And if that one level breaks and holds, don't just think number. Think forced behavior, because that's when the math changes.